Hi, my name is Alex CARLUCCI with GustanCho.com. I want to talk to you today about calculating your own mortgage payment. So if you're at home and you want to know, hey, what's my mortgage payment going to be on this house? I can give you a couple tips. Are you going to get it exactly right? No. Are you going to get close? Probably. So good enough. So I want you to always remember that you can go up to 50% on a safe thing for debt to income. It's always a safe number. So let's say you have a $400 car payment. I want you to add that to your mortgage payment, and I want to make that the numerator, and then take your gross monthly income and make that the denominator. If you're under 50% with that ratio, then you can qualify for home, and you can kind of gauge what you might be able to afford if you use that 50% debt to income ratio. Again, so it's going to be your mortgage payment that I'm going to teach you how to calculate right now, plus any monthly obligations on your credit report. That's the numerator divided by your gross monthly income. So $60,000 a year would be $5,000 a month. You put 5,000 on the denominator. So everything's like whatever you make a year divided by 12, that's your denominator. Everything's always in monthly terms, so keep that in mind. So let's do an FHA because it's probably the best way for you to calculate the PMI. So let's go with this. If you did a $200,000 purchase, and let's say the taxes were $2,400 a year, and let's say your insurance was $1,200 a year. So I made this real easy for you. I want you to first take your insurance of $1,200 a year. I want you to divide it by 12. That's $100 a month. I want you to write $100. Then I want you to take the tax of $2,400 a year divided by 12 and put 200. So you got 100, then you got 200. So there's your taxes and insurance. It's about $300 a month. Now, when you're calculating PMI, we're going to use $200,000 as a purchase price. I want you to take 96.5% of $200,000. Now, FHA adds another 1.75 back to that, but that's a little too complicated, so I don't want you to get complicated with this. But I want you to take 96.5% of $200,000, put it in the calculator, whatever it is, probably 193 or 192, I'm not sure, but take that 192, 193, multiply it by 0.85, and then divide that by times it by 0.85 and hit percent, and you're going to come up with a number. I want you to divide that by 12. And I'm going to guess it's going to be right around about 130 bucks. So let's say it's 130. Let's say I'm right. You put 130. So you got the 100 for insurance, 200 for taxes, 130 for PMI, and then the last part is your principal and interest part, which is what mortgage brokers calculate. So Google's made it real nice. You Google mortgage calculator, and really on the top, it's not even an app. It just comes up. It just shows up. You put 192 loan amount. And right now I would use 3.5 as a safe number, put 3.5% interest rate, make sure it says 30-year fixed, and it'll just tell you what the principal and interest is. It's probably going to be around $900, I'm going to guess. So you take the 100 for the insurance, the 200 for the taxes, the 130 for the PMI, and the 900 for the principal and interest. And if there's no HOA or no flood insurance, then you just add those up, and that's your monthly payment. So if you take 900 plus 130, that's 1,030 plus the other 300, you're at 1,330. That's your mortgage payment. So if that's your only debt and you're trying to go conventional, you got 800 credit score, you know that you could probably only have to make about $35,000 a year to qualify for a $200,000 house. But now you got lower credit scores, your debt to income ratios aren't as high, and there's a lot of more complicated things, and that's what I'm here for. So if you got any questions, I'll do this for you for free. Give me a call, I'll qualify you, I'll tell you how this all works. I'll train you on the phone, so call me anytime. My phone number is 630-915-7550, and please subscribe, it helps us help you.